Hello friend, in today's video I am going to explain cash flow statement with example of real world and analogies. In that I am going to discuss introduction and meaning of cash flow statement, cash and cash equivalent items, classification of activities, reporting method, disclosures. Before starting the topic, I will cite some real world story, profit versus cash flows. In that you will see Jet Airways one good example for cash, profitable but shut down due to lack of liquidity. Subiksha, rapid growth, no cash support. BlackBerry is a very big brand, positive income, poor cash conversion. General Motors, profit could not cover cash need. Kingfisher, it is a well-known airways. You can see revenue high but cash mismanaged. These are some examples of real world which they could not maintain proper cash, so they had been in problem. So profit, it does not mean that you can survive. So for surviving purpose, cash is also very important element for every business concern. One analogy is there in that we can understand with the importance of cash. Without blood, no body fails. Without cash, business collapse. Assets we can consider as organ of a business. Profit, health reports. Cash, a blood. Without blood, no business can survive. Now you would understand the things why cash is important. Why cash flows matters. Profit, it an opinion. Cash is fact. Profit can be manipulated, but cash cannot be manipulated. Business collapse from poor cash management. Cash flow statement reveals true financial health of the company. By this matters, we have to prepare cash flow. So, student, there are some questions we must know the answer of this question. Can a company be profitable and still go bankrupt? Yes, company can bankrupt if their profit is not managing properly and they don't maintaining their liquidity. In that condition company can bankrupt. Why prefer cash flow over net profit? Because it shows the real liquidity means whenever expenses is due, at that time company should have ability to pay. So that is called liquidity. So every company has power to pay, uh, to have such of money to payment the expenses whenever they occurs. What if company survives only by loans? Un- Unsustainable. Why? Because of uh, loans. If you are not able to pay the payment of that loan at the time whenever they due, so company cannot survive. For that purpose, we need to have cash. This slide is going to discuss introduction and meaning. So when we talk about cash flow, it provides a summary of cash or cash equivalent transactions during an accounting period. And that can be categorized into three forms: operating, investing, and financing activities. And also it helps to stakeholder to make understanding with the liquidity financing, financial health and ability to generate cash, making it a vital tool for investors and creditors. So there are some keywords. We must know the meaning of that keywords like cash or cash equivalent item. So cash means basically we know cash, and cash in cash at bank is also the part of cash, and cash equivalent means the item which has maturity value of 3 months, less than 3 months. So that can be considered cash equivalent items like T-bill, marketable security, certificate of deposit. These are the some examples of cash equivalent items. So when we talk about cash flow statement, it considers two things: cash or cash equivalent items of inflow and outflow. Okay, these are the main activities: operating, investing, and financing activity. In this slide, we can understand the things. So whenever we are talking about operating activity means daily activity which is happening in a business to run it. That is called operating activities like sales, wages payment, bill payment. There are many things which is happening in the business day-to-day activity, that is called operating activity. And second one is investing activity. Investing activity is basically the amount which has been uh, taken by business to invest in land, building, plant, machinery. That is called investment activities. So when we are talking about investment activity, if you are purchasing any assets, that is called inflow of cash under investing activity. And if you sell any assets, that is also the part of investing activity. And third one is financing activities. So when we talk about financing activity, we have to arrange the finance through the various sources of finance like issue of share, issue of debenture. So these type of activity we have to consider in financing activity. Now you can see there is a small picture of the cash flow statement. In that you will see there are three activities: operating activity, investing activity, and financing activity. So after adding these three items, we will get the net cash flows, and add opening cash and cash equivalent item. We'll get the closing cash and cash equivalent item. That is the summarized form of cash flow statement. Now let's So, in this slide, reporting operating activities. Actually, when we talk about direct or indirect method, it create impact only in operating activity. Other two activities are prepared in same way, in direct and indirect method. But impact creates on only operating activity. So, in direct method, if we uh, make cash flow statement, so we have to consider where from we are getting cash, like sales revenue is generating cash, that is cash inflow, and payment of supplier, payment of wages, that is outflow. So when we consider on that basis where from we are getting cash and where it is using, that is called direct method. And when we talk about indirect method is starts from the profit and loss, means net profit, and we have to check it what are the non-cash item effect on operating cash flow. So on that basis, if we prepare the cash flow statement, that is called indirect method. But which method is most appropriate nowadays? Indirect method. Because indirect method, you need to have net profit. And suppose if you don't have income statement, wherever, still you can prepare cash flow statement, because net profit we have to show in two places. One is income statement and second one is balance sheet liability side. So if you use indirect method, so there is no need to have income statements. By using balance sheet, you can prepare a cash flow statement by using indirect method. And now, as per the guideline of SEBI, all listed company must use indirect method to prepare cash flow statement. Now rule. If we talk about rules, so there are two things. Source of cash means where from we are getting cash. That is called inflow. Okay. And where we are paying cash, yeah, we are using cash, that is called cash outflow. So when we talk about if value of assets in decrease, and that means cash increase. If you sell any assets, when value of assets decrease means when value of assets will decrease, when you are selling any assets. So then value of assets will decrease. But impact of value of assets, cash will increase. And when value of liabilities increase, it means cash increase. How? Because you will add sum of amount. Suppose I take one example of creditors. If creditors is there, your balance sheet, your cash will increase because you did not pay still your creditors. So it means it is showing in your balance sheet. It means your cash is increased. And in case of assets increase, your cash will decrease because you have buy some assets. So when you will buy some assets, your cash will decrease because you will pay some of amount to buy that asset. And the second one is when value of liabilities decrease, it means cash increase. Okay. So when we talk about liability decrease means cash decrease. It means you have paid some of liability. It means you are paying some of amount as cash. So your uh, liabilities will decrease and your cash is also decreased. Now it is cleared the rule of cash flow. See the format of indirect method of operating activities. So you can see net profit before interest and tax. Then we'll add non-cash items. Non-cash items means where there is no impact on cash, but income statement we have to record. So we will add these items with net profit before interest and tax, like depreciation, goodwill written off, preliminary expenses, underwriting commission, loss on sale of fixed assets, discount on debenture, provision for doubtful debts. Only two things, that is prepaid expenses and outstanding expenses. Apart from these two expenses, all expenses are non-cash items. Almost you will see in balance sheet. So without taking any care, you have to consider in that. Depreciation is non-cash item because we don't pay anything for depreciation, and goodwill written off is also the same. So whenever you see any expenses in balance sheet except outstanding and prepaid, they all are non-cash items. So we'll add these items, and profit on sale of fixed assets. It is also not part of the cash. So we'll, after adjusting these two items, we'll get operating profit before working capital changes. Then we'll move to the changes in working capital, like current assets and current liabilities. So if current assets is increasing, it means cash is decreasing. So it will be less. And decrease in current assets mean cash is cash is increasing because you are selling some of assets. Same in increase in current liabilities, your cash will increase, and in decrease in current liabilities, your cash will decrease. So we'll get the cash generated from operating activity, and then after we'll deduct income tax, we'll get net cash from operating activities. If your answer is positive, it means net cash from operating activities. If your answer is negative, it means cash used for operating activities. So we will care of these two words, these two sentence. Net cash from operating activities means you have positive answer, and used in operating activity, it means you have negative answer. Okay, now it is clear to everyone because it is very easy to understand. Next, this slide is showing operating activity by direct method. In that you can see cash received from a customer by sales. So it is cash inflow, and cash outflow means cash paid to supplier, cash paid to employee, cash paid to other operating expenses. Then we'll get cash generated from operation. Less income tax will get the cash flow from operating activity. That is the direct method. In this video, that is the last point. In the next video, we'll discuss the detail of format of cash flow statement